You're welcome back. Let's continue in the series of capital allowance by looking at typical capital allowance questions that we use, or I want to use, to buttress all those theoretical aspects of capital allowance. We there? Okay, so this is a question here. I have a question on hand here. Let's go through the question, see what the examiner is testing, and try to tell you what you should be looking out for questions like this. Now, Harold James Venture Limited, I'm reading, commenced business on 1st June 1999. I will interpret that first line. That means this is a question that borders on commencement ab initio, from the start. Okay? So, you log on to your commencement rule. Remember what we do there. We are going to apply it here. The following results were presented. Of course, all these are familiar results, familiar things with commencement. Period 2, 31st December 1999. They found out they made a profit of 400,000. That's the meaning. Year ended 31st December 2000. They found out they made a profit of 840,000. That's what we are having there. Year ended 31st December 2001. They found out they made a profit of 780,000 naira. Are we there? So the next question is, how much of that will be subjected to tax? How much of these profits is accessible to tax? How much of these profits will be accessible to tax at different year of assessment? Remember what different year of assessment means? The year that the taxpayer is being assessed to tax. Now, we are told that during the years, capital expenditures were made. Here, capital expenditures acquired where? In other words, interpreted in FA language, financial accounting language, asset acquired. Asset acquired. Remember, in tax, we call them capital expenditure. We don't really call them assets. So I have this office building. This here, the whole of this, is the dates that they were acquired. Here, 4th of February 99, 7th of May 99, 10th of June 99, 7th of 8th August 2000. And the amount that they were bought, this represents the cost. The cost of the asset. Let me put it that way. Cost of the asset. Now we are asked to compute the tax liability. Tax liability. This is a new one. Of Harold James Venture Limited up to 2002 tax year. Are we there? So that is the question for you. So what are we supposed to do? First, one, this is our workings. We will show workings somewhere else, but these are things we are going to work on as workings. Commencement rule. Commencement rule. We are going to do that. And in commencement rule, don't forget vis-a-vis your taxpayer's option. Taxpayer's option. Vis-a-vis your taxpayer's option. Taxpayer's option. Okay? 2. These are things you shouldn't forget here. Basis period for capital allowance. Basis period for CA. Remember when we were going through the lecture on basis period for capital allowance, or capital allowance generally, I came down to a subtopic called basis period for capital allowance. And I told you that that is where one is able to determine when an asset is first entitled to capital allowance via initial allowance and annual allowance. Remember? Now, I also told you that look out for questions. Whenever you are confronted with a question that has to do with commencement rule, like this, commencement rule. Are you there? And assets were acquired. Assets were acquired with dates, date of purchase. These are the ones I've just shown you here. All of this. That you will need to show, determine basis period for capital allowance. So it is being tested here. This is tested here. This is tested with these dates. All of these dates here. This is a date. This is a relevant 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 date. That's basis period for capital allowance being tested with those dates. So with that, I think we are home and dry and we can go ahead and solve the question. And again, lest I forget, the crux of the question is that we should compute tax liability. We should compute tax liabilities. If we were to compute tax liability, we should also bear in mind that we will compute the capital allowances, which we take 50%, if not more, of this question. The computation of capital allowances. We're going to compute capital allowances, and then 4, this question is also looking at restriction under capital allowances. Under capital allowances, we're going to compute initial, annual. Okay. We are also going to compute investment, if any, investment allowance, if any. Now for number 4, after computing all of this, remember the definition of capital allowance, that capital allowance is to be deducted from the assessable profit of a business before subjecting the balance to tax. At this point here, we will have known the assessable profit for each period. We'll have known the assessable profit for each period. Then from the assessable profit, we will deduct the capital allowance. But bearing in mind, restriction of capital allowance. Restriction of CA. So that's another part of the question. This question is a full question, complete question. If this is the case, when we get our assessable profit here, compute all our capital allowances based on the basis period for capital allowance, we will now see if there will be need for restriction. Okay? We try to restrict the capital allowance. After that, we take away the restricted amount from the assessable profit. And then we will now have our taxable profit. Okay? If we arrive at our taxable profit, we are asked for the tax liability. And this is a company. How do I know it's a company? Here we are. If you come here, you see Harold James Venture Limited. That makes it a company. A limited liability company is what we are faced with here. So as a company, we'll be subjected to tax. We will now compute the tax liability. At what rate? At 30%. And then we're done. Are we there? So these are the stages we are going to go through for this question. So let's start. So we're going to start this by coming down here to show our workings. I will want to do the workings first. Workings. The workings are 1. Commencement period or rule. Commencement period stroke rule. Okay, so let's go for that. For commencement period, I'll go back and look for the year the business commenced. Which year did the business commence? I can see here that it commenced on 1st June 1999. So my first year of assessment will be what? 1999. Because that is the year the business commenced. And then 2 years following that, I am now reciting the commencement rule. 2 years following that, 2000 and 2001. Are we there? 2000 and 2001. Those are the 3 years, relevant 3 years for commencement rule. But note, I will not stop at 2001. I will go further because I have to capture everything here. All the assets, all the capital expenditure have to be captured. And more so, looking at this, 31st December 2001. That means I will go as far as 2002. I might go as far as 2002. I wouldn't know now, but when we get there, we'll see that. Okay? Because this will have to be covered. That 31st December will have to be covered in the event of things. Alright? So, let's go. So, my YOA, my basis period, okay, and my accessible profit. And my accessible profit. Okay, so we'll go from here. Accessible profit will be in Naira. Sorry, Naira. The first year, 1999. The second year, 2000. And the third year, 2001. I'll go this way. Let's see. For the first year, it shall be from the day the business started or commenced. I want to see the day the business started. I've already mentioned it here. 1st June, 1999. Okay? So, I'll go back. 1st June, 1999. That means it's going to start from 1st June, 99. Commencement rule for the first year, it shall be from the day the business started to the end of that year, 31st December, 99. Are we there? For the second year, it shall be the first 12 month of business, 1/6/99 to 31st May 2000. For the third year, it is 12-month accounting period ending in the preceding year basis. Okay? And I also told you that at this point, you have to pause, see what you should do, whether you should repeat the second year or not. Check the month of accounting year end. In this case, the month of accounting year end is December. Okay? It prepares the account to December every month. I've underlined that. So if December is the month of accounting year end, okay, it therefore means December does not precede June. Remember the shortcut I taught you. Check the month of accounting year end. If it comes before the month of commencement, in this case, the month of commencement is June. Of course, in everybody's calendar, December comes after June, not before. So if that is the case, you are going to have your 12-month accounting period ending in the preceding year basis. So it must end preceding year. It must end the year that precedes this. 2000 precedes 2001. And it must be 12 months. 1100. 2000. That makes it 12 months. So, what do? I haven't done that. We'll come back here and then get our accessible profits. For the accessible profit, we will need the information here. 1/1/99 to 31st December 99. If we look at this here, 1/1/99 to 31st December 99, we're having 31st December 99 there. For how much? For 400,000 naira. So if it is for 400,000 naira and the basis period is the same, so the amount will also be the same. So 400,000 naira comes in here. For the second year, it said 1st June 99 to 31st May 2000. We are going to look for that there. 1st June 99 to 31st December already is giving us 400,000. Okay? So it's going to be 400,000. It's going to be 400,000 here up to December, plus from December to May. December to May, that is 5 months. December as in 1st January, January, February, March, April, May, 5 months. That should be 5 months. So from January to May, what are we going to do? Of course, we have 5 months. 5 over the next amount of 840. 5 over 12. And that amount of 840 was done in 12 months. So what happens? If I have 400,000 already, so I'm looking for January to May. January to May is 5 months. All over 12 months. That is to say, the next profit was made in 12 months. How? Let's go there. Let's see Let's see. We can see it here. It was made in 12 months. That is December 31st, 2000. How much? We are looking at 840. 840. So it's going to be 5 over 12 times 840,000. I'll look out for how much that will give me. This already is 400,000. This is equals to 5 over 12 times 840. 5 over 12 times 840,000. That gives me 350,000. So this is equals to 350,000. So if you add 350,000 to this 400,000, I should be having how much? 750,000. So 750,000. 750,000. That's for that year. That's for that year. Now, for the third year, that is 2001, I have 1st January 2000 to 31st December 2000. That is because it's on preceding year basis. So let's go up and see how much is involved here. 1st January 2000 to 31st December 2000. You can see it there. That is 840,000. So without any apportionment, this gives me 840,000. 840,000. So these are the 3 years involved on commencement. But let's look at something here. Let's look at something here. This question did not specifically ask me to work on commencement rule, although you have to start with commencement rule. And taking into consideration and bearing in mind that all the profits here must be covered, you can see that so far, we have taken this figure out. We have taken this figure out. We've not done anything with 780, isn't it? So it must be included here. It must be brought into the picture here. So that means I will go down to 2002. The basis period will be 1101 to 31st December 01. And the amount will be how much? We go again and check the amount. That is the last part there. 780. 780. So the figure here will be 780. All right. So this is it. You can see everything is being covered there. At this note, we come back to take our taxpayers option. Thank you.